Welcome everyone to Cyber Trading University. My name is Adam Rosen. Very happy you could join us here tonight. Please take a quick look at our risk disclosure document on my screen. We should always be aware when trading any financial market, there is a certain amount of risk that's involved, and we should always be very well aware of that risk and only trade, obviously, risk capital in any of those strategies or positions. Now, what we're going to talk about today's a very fun session. We're going to talk about how to hedge our equity portfolio with stock options. Basically, how to hedge our stock portfolio in the options markets. The question is, why would we hedge? Why now? Well, there's a little expression that goes along these lines. Traders like to say, sell in May and go away. Historically, the statistics show that equity markets tend to fall under pressure in the summer months, especially after the earnings season, which just passed. We had earnings in January, April. The next earnings is in July, and after that is October. The earnings season gives us a reason for the stocks to move, but after those reasons have been released, there's really no new reason to buy the stock, and for some reason or another, in the summer months, we tend to see weakness. Now, we can have an entire discussion about the Federal Reserve and quantitative easing and zero interest rate policy and how that may continue to support the market. But then again, we could also have the other fundamental discussion on why that also may lead to a downturn, especially if the Federal Reserve tomorrow, when they release their minutes from the last meeting, pulls back on their quantitative easing, or at least hints at that possibility. So fundamental analysis, we could go either way. But what we do know is the stock market makes new highs almost every single day. And that there are certain positions in our portfolio, we have quite a significant amount of profit, especially for these long-term positions that we like to hedge. We like to capture some of that profit. We may not want to sell. We may not want to get out of the position, but at least we want to hedge ourselves. And to do so, there's a lot of different strategies that we can employ in the options market. Covered calls, protective puts, and we also want to hedge against the possibility of volatility, increased or decreased volatility. Specifically, when volatility rises, that's what we have to be very careful of. If we have a stock that normally trades $50 a share and has a 10% volatility, well, that's too much actually. Let's say 2% volatility. We could say, well, that stock probably averages $1 a day. But if all of a sudden that volatility increases at 10%, and now we have to become accustomed to 5-point moves in the stock, well, there are certain strategies we can use to hedge ourselves against that volatility. And we also want to hedge yourself against time decay. Now, this doesn't really affect stock traders very much, but if you have long-term options, also known as leaps, you buy a 6-month or a year call or a put, and you're nervous about the time decay, that theta in the option eating away at the value of our option, well, there's a way we can hedge against that too. That's what I'd like to talk about today. Of course, at any time, if you have any questions, feel free to chat them in as well. Now, why would we hedge? Why now? Long-term investors maintain equity positions for a variety of reasons, such as dividends. Some of the best-paying dividend stocks, obviously in the Dow Jones Industrial Average, include names like AT&T and Verizon. In fact, there's specific strategies designed to buy those highest-yielding dividend stocks. It's called dogs of the Dow. That's where you buy the lowest-priced stocks with the highest dividends. If we want to continue to collect those dividends quarter after quarter, year after year, it behooves us to hold on to that stock position for a long time. We may also just look at the long-term trend in a stock like AT&T and Verizon and say, you know what, so the trend is your friend and the stock continues to go up. Why not stay long? And also for tax reasons, there's different tax implications whether we choose to day trade a stock or hold it for more than a year. Maybe we want to hold on to that position. Well, all of those reasons are certainly very valid, but we still would maybe want to hedge these positions along the way. Seasonality, market uncertainty. What will the Federal Reserve say tomorrow? It's been hinted that the Federal Reserve is going to in the very near future, give us a strong hint that they're going to pull back on quantitative easing. Right now, they're printing $85 billion of new money to buy long-term bonds and mortgage-backed securities. If they pull back on that quantitative easing at all, Well, there's a lot of people out there that think the stock market could certainly come down. Rising volatility, time decay, these are all issues that we have to consider when we're holding a long-term position. First position or first strategy, covered calls. How many here are familiar with covered calls? I'm guessing that almost every single person is going to say yes. It's the ABCs. John says yes. So is Richard, Craig, Doug, Don, Mike. I can't read the names fast enough. Good. Okay. Covered calls are used to protect existing positions and generate an additional amount of income as volatility cools off, especially when volatility cools off. See, this is one of the reasons why, and I know this is probably a little bit of a review for some, but this is one of the reasons why I really wanted to talk about this now. We're just at the tail end of May earnings season. Actually, it's April into May. Volatility is probably at its highest point for a lot of stocks that we've seen in several months and probably will continue to see for several more months. And as that volatility starts to decrease, we may be tempted to say, well, maybe XYZ stock is going to go down. I want to buy a put. Maybe XYZ stock is going to go up. I'll buy a call. But in a climate of declining volatility, it really is in our best interest not to buy puts, not to buy calls. Because when you buy a call, you have something else called the vega, which measures the volatility. And even if the stock moves in our favor, we buy a call on XYZ stock and the stock actually goes up, if that volatility drops at the same time, we could actually still lose money on that position. By the way, we're hosting tomorrow, I almost forgot, tomorrow we have a workshop. If you're interested in more learning about the Greeks, the theta, the delta, etc., tomorrow is the day. We're going to get really, really involved in that. I'll give everybody a link afterwards. I just wanted to mention it. Okay? So for every 100 shares of an existing position, 100 shares of XYZ stock, the strike price that we choose is based on our near-term expectations of where the stock will trade to. If we're very, very bullish in the stock is $50 a share, and we think that in the next month it may go to 55 or 60, we want to sell a covered call to generate a little bit of additional income. We want to sell a covered call to hedge ourselves to protect against the downside, but we would want to sell a more aggressive covered call, meaning more out of the money. Everybody understand the difference between in the money, out of the money, and at the money options? If you don't, I know 95% of you probably do. If you don't, let me know. If you have a stock that's $50 a share, the call that's at the money will have a strike price of 50. If it's in the money, the call is lower, meaning it's inside, it's in the money already. The strike price would be 45. If it was out of the money, meaning it's above us, where we expect the stock to go, it would be considered out of the money. Puts, same thing, only opposite. Out of the monies, meaning that we think that the stock is going to go lower. The out of the monies are below us. Out of the money options are where we think the stock will go. In the monies is where we already came from. If the stock is at 50, it was already at 45, that would be in the money. Out of the money is 55 above us. Let me know if any of this doesn't make sense at all. Love this stuff. I love to talk about this stuff. Now, if we're bullish about our existing position, and I have examples to show all of you, we would want to sell an out-of-the-money call, meaning if the stock is 50, we may choose to sell a 55 call or maybe even a 60 call. If we're neutral on our existing position, if we're bearish, I would say we just sell the stock. Or if we're neutral to slightly bearish, we would sell an in-the-money or perhaps an at-the-money option. Meaning if the stock is 50, we may want to sell a 50 call, or maybe a 55, or in some cases, maybe even a 45. Now the max profit, the max amount of profit that we can receive from this covered call strategy is the strike price of the short call minus the purchase price of the stock plus the premium that we receive. And I have examples to show you. You don't have to remember this. And this is a hard way to learn this. The example that I have in the next slide is the easy way. The max profit is achieved if the stock closes at or above the strike price of the short call. And this is a rule of thumb that we talk about, for example, in tomorrow's workshop when we really get into the Greeks, the delta and the theta and the vega, that when we're looking at a strategy that has a short option, The same way you would short a stock, you can also short an option. The short option is always, in my book, this is the way I remember learning it, it's always the most important element of the option strategy, because that tells us where ideally we want the stock to go to. If we're talking about a call options we buy if we think the stock is going to go up. If we think the stock is going to go down, or at least not go up, we would sell a call option. Where ideally, for our maximum profit potential, where do we want the stock to go to? Just at the call strike price. Meaning, if a stock option has a 55 strike price, we want the stock to go to 55. The maximum loss in this strategy is the current strike price, current stock price, I should say, minus the premium we received. Obviously, if the stock is $50 a share, and we hold on to the stock, and the stock goes from 50 to 0, our maximum loss is only 50. But it's not 50, it's actually a little less. It's less the amount of premium that we received collected from writing that call option, from selling that call option. To answer your question, tomorrow, it's on tomorrow's schedule. I'll give everybody a link after the fact. Whoops. I'll give everybody a link after the fact, after the show, I should say, for tomorrow's workshop. It was a question of when it will begin. It's under our under our event calendar, I should say. I'll give everybody the link at the end of the show. It starts tomorrow, by the way, at 12 noon, okay? That's for the workshop. This workshop, this seminar that we're doing right now, tomorrow's day 2 is at 9:30 a.m. Everybody good on the covered call theory? Well, if not, this example is going to answer all your questions. Here's an example. We buy 100 shares of XYZ stock at $50 a share. We decide that we believe the stock is probably not going to go up in the near-term future, and we want to generate a little bit of extra income, and we want to hedge ourselves. We want to protect some of our profits that we've received, or at least protect from the downside. So what we decide to do is we sell one call option with a 55 strike price and collect a $2 premium. Okay? Make sense so far? Now, can anybody answer the question, why, if the stock is 50, would a call option that gives me the right to own the stock at 55, why would I have to pay an additional $2 premium on that? I know, we have option pros in here, so this is an easy question. Why, if the stock is 50, would a 55 strike price option, which is out of the money, we haven't gone there yet, why would we have to pay $2 in premium for that? Well, the answer, very simply, is the time decay. We didn't specify the month of the expiration, but very simply, the call option gives us a right to own the stock at $55 a share. If I chose to buy the option, I would have the right to own the stock at $55 a share no matter what happens. The options market, the calculation, the math behind it, the Black-Scholes theory, has determined that I need to pay a $2 premium for the right to own it at $55 a share. Now, again, the max profit is a strike price of the short call minus the purchase price of the stock plus the premium received. That means the maximum amount of profit that I can make is 55 minus 50, the strike price minus the stock price, plus the premium. 55 minus 50 is 5, plus $2 in premium, 7. The maximum profit is achieved if the stock closes at or above the strike price of the short call. What's the strike price of the short call? 55. So if the stock travels to 55, let's think about this. We own the stock right now. We bought it at $50 a share. At the same time, we decided to write the option. Write meaning sell. It's the same thing. We write a call or we sell a call. It's the same terminology. It means the same thing. So we bought the stock at 50, and we sell or we write a 55 strike call option. We collect an additional $2 in premium. We collect it because somebody else is buying that option, we're selling them the right to own it at 55, so we collect the premium. It's kind of like we're the dealers in the casino. Somebody places a bet. They made their bet. They have the right to win, possibly win something. We have the obligation to pay them if they win. If they don't win, the casino keeps the entire bet, right? Well, in our case, we want to be the casino. So somebody else wants to make a bet that the stock is going to go to 55? I don't think so. I'll take the other side of that bet. You pay me $2, and if you're wrong, if the trader who bought the option is wrong, they lose their $2 in premium, and we collect it. We keep it. So let's imagine this. We own the stock at 50, and it goes up to 55. What is the magic thing that happens at 55? Well, first of all, we made $5 in our stock trade. Stock's 50, goes to 55, right? But the other thing is, if the stock closes exactly at the options expiration, or I should say the strike price, if on options expiration the stock closes at or anywhere below the strike price, 55, 54.99, 54.98, all the way down to 0, we collected $2 premium. They made a bet the stock was going to be above 55. They were wrong. So I made $5 in my stock trade, $2 in the premium I get to keep, $7 profit. Everybody see how that works? Easy stuff, right? Anybody not understand? If you don't understand, don't be shy. Let us know. I know this is new, and believe me, it took me, it took me a little while to get my head around it the first 6 or 7 times. But you practice these concepts over and over again, and I promise it gets very easy. Everybody good? Well, great question. Don says, I thought it was at or above. I mean, I just said at or above. In fact, I wrote on the PowerPoint at or above. You are correct. The ideal spot for the maximum profit is at or above 55. What happens if the stock goes to 56? Well, now we've made $6 on the stock trade, but the problem is this. We sold an option for $2 premium that gives the other trader, the person on the other side of the trade, the buyer of the option, the right to own the stock at 55. On options expiration, if that stock goes to 56, now that option that the other trader bought is worth $1. So now we have to, in order to buy back that option to close the trade, we have to pay the other trader $1. We collected 2, but we have to buy it back for 1. So we made $6 on the stock trade, $1 we lost on the option trade. Net, we're still $5. Or, well, I'm sorry, actually 7. Does everybody understand how that works? It's actually, yes, exactly right. Okay? If the stock goes to 65, we've made $15 on the stock trade, but now we've lost the same increment on the option trade. So it's 55, which is a strike price of the short call, or anything above it. The stock could go to $1 million. We know with the strategy, it's not unlimited profits. There's a maximum profit. And that's a strike price of the short call minus the purchase price of the stock, 55 minus 50, plus whatever premium we received. The maximum loss is the current stock price, $55 or $50 a share, minus premium we received. What if the stock comes out with earnings and it goes to 0 tomorrow? Well, we lost $50 in the stock trade, but we also collected $2 from the premium. So, and I know that doesn't make us feel much better. If we lose $48 on the stock, it's still, a disaster. This strategy is limited profit, limited protection. It's a very conservative type of strategy. It's a strategy that you use when, you're very confident in the long-term position. You're bullish long-term. Oh, this is a great company. They're going to continue to really make a lot of money. But we've reached a point where we think the market's going to slow down a little bit, maybe even pull back. And we see that there's a lot of volatility in the market. The premiums are very high. When the volatility increases in the stock market, the option premiums also increase. So you could write these options for a lot of money. Question, do we have a risk of assignment at 55 or 55.01? Assignment, by the way, is when the other side of the trade, the other person that bought the call option says, you know, I bought a call option. I have the right to own the stock at $55 a share, and I want to exercise it. It's actually called, you know, option exercising an option. As far as I know, and I haven't read the options rule book 101, you know, in I don't know, 15 years, but as far as I recall, it occurs at $55.01, meaning that why would you want to exercise? And if somebody has read the rule book more recently than me, please, you know, let me know. But why would somebody want to exercise an option to own the stock at 55 if the stock is already 55? If the stock goes to 60, then they would want to exercise the option to own it at 55. But I believe it's $55.01. Technically, they have the right, and we run the risk of someone exercising that option. If that occurs, all we do is we just sell our option to close a trade and book in the profit. Or if it was a short call, the loss. And we would, and again, this is not a short naked call, it's a covered call. It's a stock that's covering the option, so there's a limited amount of risk in this trade, okay? Okay, Roy, you're on private chat. Bottom line, $50 minus 2 is 48. Well, it's as far as the maximum risk, if that's what your question is. It's the strike price minus the purchase price of the stock. So it's 55 minus 50 is $5 plus the premium that we receive. So it's $5 plus 2 is 7. Just think, if the stock we bought at 50 goes to 55, we made $5, and we still get to keep all the premium in the option. That's why whenever we're looking at an option strategy, tomorrow we're going to start on some really complicated stuff, but we're going to make it easy. But you know, different strategies with multiple different positions. Always look at the short option. That's what I've always, you know, been taught. Or I was taught originally, I always tried to remember. Okay, strategy number 2. Strategy number 1 was covered calls, limited protection, limited upside. It's a conservative approach. This is a little bit more of an aggressive approach. Don, let me just to clarify your question. Are you trying, as far as you're trying to figure out the maximum risk? Don, if you don't mind, just please clarify your question. I'm not exactly sure what you were referring to. I'll come back to it as well. Protective puts provide insurance in case a stock in question moves lower any time before expiration. For every 100 shares of an existing position, we buy 1 protective put. The maximum profits that we receive is the current strike price minus the strike price of the put minus the premium paid. And again, the next slide makes this a lot easier. The maximum profit achieved is as the stock price continues to move higher. We have a virtually unlimited profit in the sense that we bought the stock, we own the stock. If the stock goes to 100 and we bought it at 50, we're going to make 50 points. If it goes to 1 million, we make 1 million points. The put is not what makes us money. The put is what protects us against losses. The maximum loss on a put, on a protective put, is just simply the amount of money we spend on that put. Can't lose more than that. The maximum loss occurs at or below the strike price of the put option that was purchased. I'll show you what I mean. And I know those questions about the previous slide. We'll go back to it. I just want to make sure that we get everything because my webinars, for some reason or another, I tend to run long. But we're going to be going over all this information again at 8:30 tonight as well. But I'll try my best to make sure that all the questions are answered tonight as well, or today. Okay, so here's a protected puts example. The max profit is achieved when the current stock price minus the strike price of the puts minus the premium pay. Let's look at a real example. We buy 100 shares of XYZ stock at $50 a share. We're nervous that maybe the stocks can go down. Maybe they have earnings coming up. Maybe it's just, a bad time of the year for this company. We're going to buy a little bit of protection. Think of it as insurance. We buy one put option with a 50 strike price, and we pay $2 in premium. Now, when we buy a put option, we have the right to put the stock or to sell the stock back to the market at that particular strike price. If we buy a 50 strike price puts, we have the right at any time, no matter what happens in the stock, to sell that stock back to the market at 50. Whoever sold me that option has the obligation to give me the stock at 50. If the stock goes at 10, I still have the right to put it back to the market to sell it at 50. For that right, I have to pay a premium, which is $2. Now, let's say I was wrong. The stock was going up before, it goes up more. We bought it at 50, and now it goes up to 60. So we've made an additional 10 points on the stock, but our insurance, we spent $2 on, we lost that. So we made $10 in the stock price, we lost $2 on the put. Remember, if the stock closes above the puts or below the call, the stock expires worthless on our option expiration, which is the third Friday of every month. We can buy 1-month options or 3-month options or 2-month or however long you like. And just to make things easy, we'll talk about 1-month option. If we're nervous about this month, we buy insurance for 1 month, that if the stock goes below 50, whatever we lose in the stock, the put will make up to the same degree. But we were wrong in the first example, and the stock goes from 50 up to 60. We made 10 points on the stock, minus the $2 in insurance, meaning the put. We made $8. But the good news is, if the stock goes to 70 or 80 or 100, however high it goes, okay, our $2 insurance just gave us insurance at $50 or less. If the stock goes to 100, we make 50 more points, and the insurance, obviously expires at 0. I like to always say we never complain. We should never complain about not using insurance. If we don't need to use insurance, it's a good sign. It means that our car hasn't blown up or our house hasn't, fallen on its side or anything like that. Now, if the stock trades down to $40 a share, we've lost $10 on our stock investments. But what we've lost in the stock investment, we make up for on the puts, which means every point that the stock goes down, the put increases by 1 point. Now, for those of you that are going to take part in our workshop tomorrow, we're going to talk about concepts like delta. Delta actually is a relationship, measures a relationship between how much a stock moves and how much an option moves. And the real truth is, it's not a one-to-one relationship. There's a different relationship depending on if the option is in the money or out of the money, if we have a long time until expiration or a short time to expiration. Our slide talks about the theoretical value at options expiration, not 3 days before or 3 months prior. At options expiration, if the stock is at 40 and it's gone down 10 points, our put that we bought will go up by 10 points. That $2 put will become 12. The $50 stock will go down to 40. And net, our stock investment is hedged. We only spend $2 on the insurance. So either way you cut it, we spend the money on the insurance. But when the stock goes down, the insurance protects the rest of the stock position. Everybody good with that? Okay, let's get complicated now. As the equity markets rise, volatility tends to decrease. Is everybody familiar with something called the VIX, the volatility index? Is anybody not familiar with that? I know it's a pretty common concept for those of us in the cyber group. The VIX is basically, it's also known as the fear index. Okay, good. I'm glad that somebody is not familiar with it. The VIX, and you would actually type in the symbol VIX, it's also known as the fear index. It basically measures the premium on the options on the S&P 500. The way it works, what it does, and I have a really cool chart to show you in a second, what it does is it measures the amount of fear or volatility in the markets. When the market is very complacent, very comfortable, things are great, the stock market went up yesterday, it went up today, I think it's probably going to go up tomorrow, there's not a lot of volatility. Ever notice when the stock market goes up, usually goes up in little fits and sputters, 20 points a day, 50 points the next day, maybe on a big day it'll go up 100. But what happens when the stock market goes down? It doesn't go down 20 points in a day. It goes down 100, then the next day goes 500, then the next day goes 800 to the downside. The volatility usually expands exponentially when stock markets go down. Volatility decreases as stock markets go up. The VIX index is what it basically does is it measures the amount of fear or volatility in the markets. Now, historically, the VIX usually remains between a range of 15 to 40. If the VIX is at or below 15, it means we're very, very complacent and comfortable. If it's at or above 40, it means we're very scared. Usually, the market bottoms out after like a big flash crash or something. The market will bottom out near 40. The market will bottom out as the VIX is up near 40 or maybe even a little bit higher. And usually when the market hits a top, the VIX historically is usually around 15. Now, I said historically. Anybody know where the VIX is today? I didn't even look because I know there's so many people here that do know. 12. The VIX is at 12. Anybody know how long the VIX has been at or around 15? I don't know. 6 months maybe? Maybe more? Long time. Very long time. Now, this is a completely separate discussion about quantitative easing and, but the fact of the matter is the stock market has been going up a lot this is such an apropos time to talk about the VIX and the volatility and the risk of volatility. We have very, very little volatility right now. We're coming to June, we're going to have even less volatility because there's no earnings in June. But July is earnings season. And volatilities tend to spike. And aside from that, the fact that we've had for a very long time that very low volatility, I was wrong yesterday in saying that volatility was going to rise, and I was wrong the day before, and I've been wrong for, months and months. But nothing lasts forever, and eventually volatility will increase, and the VIX will go up. And we need to be able to protect our positions against that. Another way to think about it is if you want to hedge yourself against volatility, it basically means hedging yourself against the stock market going down. It's been in the 12 to 14 point range since January. Gary, I'd say even more than that. I don't have the chart in front of me. I'm sure if what you're looking at, that would be accurate. But I know it's been there for a very long time. I was talking about the VIX at 15, since forever. Now, as equity markets rise, the VIX falls below 15. Traders may purchase an out-of-the-money VIX call option to protect a portfolio. So the VIX right now, it's $12, $13. If we're long a whole different portfolio of options, stocks, I should say, we own AT&T and we own IBM and Verizon and General Motors and GE and, so many different positions. How do we really hedge ourselves? And maybe some of the positions are in the S&P 500, maybe some are in the Dow, maybe some of them are small cap stocks. How do we hedge ourselves against our portfolio against a rising state of volatility? We could very simply buy an out-of-the-money VIX call option, meaning a call option out of the money. The VIX is 12. We might buy a 13 or a 14 or a 15 or maybe even higher than that. And that, again, only as a hedge. That if all of a sudden the stock market decides to go down 500 points all at once, the VIX will rise substantially and our call option hopefully will make up what we've lost on our stock portfolio. Now, Joseph mentions a very good point, and then I'll answer Mike's question. Excellent, excellent points. I believe, Joseph, if I'm not mistaken, you're referring to something called a beta. The beta is the relationship between a stock and its overall index. Usually we talk, and correct me if I'm wrong, I haven't thought about beta in a while, but correct me if I'm wrong, but when a stock has a beta of 1, it basically has a positive relationship, a 1-to-1 or close to a 1-to-1 relationship with the overall index, which means you have XYZ stock that has a beta of 1, and the stock market goes up 1%, that stock should also go up 1%. You want to make sure that the stocks you have, if you're going to buy VIX options, call options to protect your portfolio, you have to make sure your portfolio has a positive beta, a beta close to 1. Because sometimes the stock market might go down and the stock might move outside of the expected behavior. It might not go down. Some stocks don't go down when the stock market crashes. Some stocks don't go up. They do not have a correlation with the stock market. We want the stocks that do have a correlation with the stock market. And by the way, if you go to Yahoo Finance or any MSN Money, any one of these free websites, they'll talk about the beta. They'll list the actual beta. If the beta is 0, there's no correlation. If it's negative, I believe it has a negative correlation. You want to look for a beta of 1 or close to it. It's usually beta, it's 1 or a fraction, a percentage of that. Oh, we talked about it here. Equities should have a high beta indicating portfolios a high correlation to the S&P index. Now, Mike asks the question, well, how far out do we want to buy the call options? Now, this is a very loaded question. We're going to talk about this in a workshop tomorrow as far as theta and time decay. We have to be obviously very, very aware of that. We can buy very short-term call options on the VIX if there's a specific event that we want to protect our portfolio from. For example, tomorrow, Federal Reserve is going to release their minutes from their last central bank meeting. If we're nervous that Ben Bernanke, chairman of the Federal Reserve, is going to come out and say, you know what, we're canceling quantitative easing, we're raising interest rates by 3%, you know, I don't care about anything else, this is what we're going to do. We would want to buy short-term options to protect yourself from a specific event. And Gary's right, I mean, it does depend on your strategy as well. It's not always good to buy just short-term options because a lot of the time that, you know, we're paying for time decay. We're paying for something that's we're gonna lose very, very soon. Now, Richard makes a good point. Sell premium than anything else. But the issue is, I wouldn't want to, first of all, we can't really, well, I guess we could sell the premium on the puts. But buying the out-of-the-money calls, from what I've read, I think it's like the most, I don't know if it's the most efficient, but it's the least expensive way. Or at least it's the easiest way to implement insurance. Is beta related to theta and gamma? Well, it's technically, I guess it's a Greek calculation, but beta talks about the relationship of the stock to the S&P 500 or to the overall index. Theta talks about time decay. Delta is relationship of the stock price to its option. Gamma measures the rate of change of the delta. Vega measures implied volatility. By the way, all those that we spoke about just now, except for beta, is in our workshop tomorrow. Tomorrow we talk about Vega, Delta, and Theta. That's tomorrow's workshop. Not in this workshop. We're talking about our spreading strategy workshop that I'll tell you about before we leave. Okay. What we're looking at right now is a chart of the VIX. The VIX is a volatility index. Now, we said usually it trades between a range of 15 to 40. 15 is a good time to buy the stock market because volatility is very low. No, sorry. 15 is a good time to sell the stock market because volatility is very low and complacency persists. 40 on the VIX is a good time to buy stocks. October of 2008, stock market crashes. Look at the VIX, 79. I don't think the VIX, at least in modern history, has gone up to 79. Anybody know? It was not there. I do not believe it was there in 2001. I think this is the highest high the VIX has seen, at least in the past decade or so. When the stock market started to rally and we reached temporary high, in April 2010, the VIX was down to 16. Then we had a little bit of an upset in the stock market. The VIX goes back to 41. Great time to buy the stock market there. Stock market starts to rally again. VIX is down to 14. Then August of 2011, S&P downgrades U.S. credit rating. The VIX goes up to 43. And look where we are now. Higher stocks all the way. Lower VIX. Next chart shows the same dates, but on the stock, on the Dow Jones Industrial Average, on the stock charts. The lowest low, well, not the lowest low, but October 2008, this is the same date. I made sure the dates are the same. So take a look at this. October 2008, left side of the chart, market bottoms out. VIX hits its high, 79. April 2010, stock market tops out. Dow Jones Industrial Average tops out around 11,600. Very quickly comes down to 10.5. April 2010 to May 2010. Wasn't that the flash crash that we had? Remember the Dow went down about 1,000 points intraday? We'll take a look what happened to VIX. 16 to 40. April 2011, VIX hits the Dow hits a very significant high. April 2011, VIX hits 14, below 15. August 2011, S&P downgrades U.S. credit rating. Dow Jones Industrial Average down 2,000 points in a matter of weeks. The VIX hits 43. Dow continues to chug higher, 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 higher. VIX, lower, lower, lower. Now, taking into consideration the VIX, does anybody here think that we might need to protect ourselves against some volatility? The VIX hit 90 in 2008. I believe you're right. What did my chart say? This is based, I think, on monthly charts. We're looking at monthly closes. Yeah, we did hit intraday, or at least for one day, we did hit actually higher highs. Does anybody think now, looking at this VIX, overlaid with the Dow Jones charts, it might be a good time to look to hedge, to protect ourselves a little bit? I think so. Again, you know, it may seem silly. We're going to buy puts, and what if the puts expire worthless? Okay, so we bought insurance that we didn't need. You know, you buy a $50 stock, it goes to $100. I'd spend $3 or $4 on insurance to protect ourselves. Who knows when this is going to happen? Now, we're going to try to time the market. Then we have to look at, the fundamental analysis and everything else. I told you when the sell options in the VIX, when the VIX is high, we could sell VIX options, but the strategy that we're talking about is to buy here. This is the best way I remember saying it. As equity markets rise and the VIX falls below 15, we want to purchase out-of-the-money VIX call options to protect our portfolio. In other words, we're at the VIX right now. I think that the stock market could see some down moves. I'd want to buy an out-of-the-money call option, let's say right here. So if the stock market goes down and the VIX goes up, we're protected. We could also sell options when the VIX is high. But this is a very low-cost, very, very easy way to buy insurance, because we know if anything bad happens to stock markets, if we have a portfolio, we have to pay commissions in the spread on every single option we buy. What if we have a portfolio of 20 stocks? I don't necessarily want to buy 20 different options. So 20 commissions, 20 spreads. It's a lot easier just to buy one position, one option, one call option, relatively inexpensive call option on the VIX. And we could do that just to protect ourselves in the month of June. We could protect ourselves from the earnings season in July. If there's some other fundamental event that we're nervous about, we just buy the protection to last us through that event. It's a very, very easy way to buy insurance. Time decay. How long should you buy those for? Meaning the VIX options. Well, again, it depends on the event. I am not so nervous about June except for the Federal Reserve. But again, No, we think back, okay, so we'll go back really quickly. We'll go back to 2011, August of 2011. The headline news was that why did the stock market all of a sudden turn down in August of 2011? It was because Standard & Poor's downgraded the U.S. credit rating. That was a catalyst. But what was really the news behind the news? It was the Federal Reserve had ended quantitative easing too, their current round of stimulus at that time. And that really pulled the floor out from underneath, pulled the rug out from underneath a lot of stock positions. We didn't have any more stimulus. All of a sudden, it just ended. And I don't know if anybody anticipated that, that to have that kind of dramatic effect, but it did. The Federal Reserve is going to release their minutes tomorrow. I don't know necessarily that they're not going to do it that way again. I think they really want to pare back on the quantitative easing much more slowly. But still, if we feel that in the next few months, through the summer months, for whatever reason, the stock market, our positions are at risk, you buy an option for a couple months. It really depends on your outlook and the fundamental risks that are ahead of us. June, I'm slightly hesitant about. July is earnings season. That's a lot of volume. So if there's bad news, a lot of volume, we can have a lot of bad stock prices. Now, this does not apply so much to stock investments, but if we want to buy a long-term option, I think that Tesla stock is going to go up 100 points in the next year. But I don't necessarily want to lay out $60, $70, $80 a share. I could buy a very deep in-the-money option, probably pay a fraction of that, and give myself the right to own that stock at a predetermined price. And when you buy very, very long-term options, you have the right to own that stock for a long period of time. But over time, especially as the option comes closer to its expiration, we run the risk of time decay, also known as theta. That's where an option, all options are depreciating assets, just like an old car. Every single year it gets a little bit less valuable. And that as you closer to the expiration, obviously that car, not a car is not a good example, it's like a quart of milk. If you go to the supermarket, you buy a quart of milk, it has that date on it. It says sell by January 4th. Well, that's okay, But what if we go to the supermarket and the quart of milk says sell by today? Who would want to buy that? Theoretically, that quart of milk should actually be a lot cheaper because you only have one day to use it, or one day at least theoretically to buy it. Well, it doesn't work that way in the supermarket, but it does work that way in the options market. As we get closer to time until the expiration date of the option's value loses. It's called time decay. How can we protect our long-term options against time decay? Time decay accelerates again as options expiration approaches, with the greatest amount of depreciation in the front month, meaning the current month. June options are going to decay a lot faster than July's. July options will decay faster than in August, and it's exponential, meaning that if you're going to look at the depreciation over time, you have the Septembers that depreciate a little bit, August, July, June, May. They decline, they decay faster as we get closer to expiration. Time decay is also more significant in at-the-money and out-of-the-money options, with less time decay within the money options. So if the stock is 50 and we buy a 55 strike price call, anybody ever do this? I used to do this all the time when I was really new in the options market. We see the stock is like $20 a share, and we look at the chart and we say, you know what, or 20, let's say it's $50 a share. And we think the stock could go to 70. And we look at the 70 call, and the 70 call is only 25 cents. We think, wow, if the stock goes to $80 a share, my option only costs 25 cents. It's going to be worth $10. I'm going to make 40 times my money on this trade. Anybody ever do that before? Or is that just me? You do the math, the theoretical math. What if I buy a 10-cent option and it goes from 10 cents to $3? And what usually happens? Maybe the stock could go up a little bit or down a little bit, but it goes up or down and our option doesn't really gain a lot of money. But all of a sudden, we hold that for a couple more days, and then the value just completely disappears. Well, there's a couple of different reasons why that happens. First of all, it's the delta, which is the relationship of the stock to the option. And You know, that's very, very little in out-of-the-money options. But out-of-the-money options also have a lot of time decay. What's the chances that, you know, John Cougar Mellencamp is going to become the president of the United States next election? Probably close to zero. So what would the payout be? 10 million to 1. To minimize the time decay, traders tend to purchase in-the-money options with a significant amount of time before expiration, at least 3 months. 3 months to me is the magic level. Anything less than 3 months, a lot of time decay. More than 3 months, less time decay. In-the-money options means if the stock is 50, would buy the 45 calls or the 40 calls. They're more expensive when you look at them, but the time decay hurts us less. But there still is some time decay. So you want to take a theta positive trade, which means you make money on the time decay. Well, if we know that the in-the-money options have less time decay, then the out-of-money options have more time decay. And we know that the long-term options have less time decay, the short-term options have more time decay. So a hedge or an option strategy that we're going to talk about a lot tomorrow is something called like a bull spread, a bull debit spread. And that basically means we'd buy an in-the-money long-term option, call, and we'd sell a short-term out-of-the-money option to hedge the longer-term option. If I just went about 1,000 miles again ahead of some of you, I really would recommend joining us for this workshop that we're going to be hosting tomorrow. It's called Using the Greeks to Spread the Options Market. We're going to be talking all about option spreads. It's a lot better than going into this options market and buying calls and puts. Most calls and puts expire worthless. Selling options, hedged options, is a much more consistent, plausible way to maneuver the markets. Now here's an example of something called a neutral calendar spread. Richard, I'll give you the links. I'll give everyone the links, I promise, afterwards. We have to register for tomorrow's continuation, day 2 of what we're doing today. But what I'm referring to is actually a separate workshop that we discuss in a lot of depth, the Greeks, meaning theta, beta, delta, etc. Not beta, but theta, delta, and vega. Okay, here's a neutral calendar spread. XYZ stock is currently trading at $50 a share, which we believe will rise over time, but may fall back into a trading range for the next month. Okay? What we want to do is purchase one at-the-money call option. Oh, thank you, by the way. Thank you very much, Cyber Trading, by the way. They just sent us the link. We purchase one at-the-money call option with a 6-month expiration. We just talked about this. In the money or at-the-money strike price. We pay $8 in premium. At the same time, we would sell an at-the-money call option front month that expires this month to collect $2 in premium. Remember, we bought and sold 2 call options with the same exact strike price, $50 a share, $50 a share. The only difference is the option that we bought has a long-term expiration, 6 months. The option that we sold has a short-term expiration this month. If XYZ stock closes at or below $50 a share this month, by this month's expiration, we keep the entire $2 premium. Remember, the most important thing in an option strategy is where the short option strike price is. In this case, the short and the long option both have the same strike price, $50 a share. But as long as the stock or the option closes, I should say, as long as the stock closes at $50 a share, we keep the entire $2 premium. How much is a call that gives me the right to own the stock at 50 if the stock is at 50 on expiration? It's worth 0. Okay? Running short on time, I want to go back to that question on the call options. Might have been a little bit confusing, okay? And then I'll give everybody a link for tomorrow's session as well. By the way, again, we're going to be doing this again tonight at 8:30. It's the same material as before. Did I make an error? I made an error. Yeah, you're right. I'm sorry. Here, let me have to correct that. You know, I checked this how many times, and still there's mistakes. I have to talk to my assistants, which is me. It's very, very simple, though. In terms of a covered call, we buy a stock, 100 shares of a stock, at $50 a share. We think that there's a moderate downside risk that we should be aware of. We're going to sell a 55 strike price option, a call option. We're going to collect $2 in premium. Okay? The maximum profit is the strike price of the short call minus the purchase price of the stock plus the premium we received. So it's 55 minus 50 plus $2. So 55 minus 55 plus 2 is 7. The easiest way that I always remember this is I say, okay, where did I buy the stock? I bought the stock at 50 over here. At what price is my short call, the call option that I used as a covered call? 55. So what happens if the stock goes from 50 to 55? I make $5, right? The stock goes up $5. I've made that. Plus, because we're exactly $55 a share, I get to keep, guess what, the premium. So $2. So I always like to think, okay, the call is here at 50, the stock is at 50, I think it's going to go up to 55, I make 5 points plus a 2 in premium I get to keep, then obviously. Now what happens if the stock goes to 60, right? I make $10 on the option trade, on the stock trade I should say, excuse me, and I lose, theoretically, $10 on the option. So that 2, that option that I sold for 2 goes to 12. I'm responsible for that difference, but I've made back that difference. So that's why it doesn't matter if the stock goes to 60 or 600 or wherever. A covered call, you know, we have covered calls and we have protective puts. Those are the 2 easiest, most commonly used ways to hedge our equity positions. The real difference is this. With the covered call, we have limited upside potential and limited downside risk. Okay, the stock could go to 0. We're not hedging. We're not protecting the entire position. We're just protecting $2. And the stock could go up, but we're not going to make money forever. If the stock goes up to the strike price, and then that's it. So what's the benefit? It's because we're able to collect premium along the way. You know, we have a stock investment. You know, let's say we were lucky enough to buy Citibank when it went down to $1. Remember when that happened in 2008, 2009? Citibank and Ford, you know, they went down to General Motors. It went down to $1 a share. There's a lot of people that probably said, I'll buy 1,000 shares. Why not? I'll buy 500 shares. They probably still have it. Maybe they have even a bigger position. What if you have 10,000 shares of Ford when you bought it when it was $1, and now the stock, $10, $20, $30, wherever it is, you know, you have a very sizable position. You don't necessarily sell that because maybe you want to give 10,000 shares of Ford to your grandchildren, you know, 300 years from now. Well, not 300, but a long time in the future. Well, how can I generate some income along the way? Well, if I could have 10,000 shares and sell an option for $1, you could generate an additional $10,000 every single month. When we say $1 in premium, that's per 100 shares. 1,000 shares is $100, so on and so forth. Okay, let me give everybody the schedule because I know people have to leave. We started a little bit late. Okay. First link. This is our events calendar. I'll send everybody the link as well. This tells us where and when we're going to be and all that great stuff. Okay, so the first link shows us that tonight at 8:30 p.m., we will be doing this session again. What we did so far, we're going to do it again. Some people weren't able to join us. Tomorrow morning, We're going to meet again at 9:30 a.m. Eastern. You have to register for that. You should all receive an email with the registration instructions, okay? That's tomorrow at 9:30. That's a continuation of today. Tomorrow at 12 noon is something completely different. Tomorrow at 12 noon is the first day of a 2-day workshop using the Greeks to spread the options market. Here we're going to talk about delta, vega, theta. We're going to talk about an entire plethora of different trading strategies, vertical debit and credit spreads, calendar spreads, butterflies, condors. It's, you know, there's a ton of stuff here. I have this suspicion we're probably going to have to host an extended session. It's, you know, it's not a workshop. It's more like a small course. I wrote the PowerPoint myself. I just got done. I think I put too much in, but can't take any of it out. It's all necessary stuff. It's an unbelievable program that we put together. Now, on top of that, normally it's $189. As part of a promotion that we ran for our previous free session, we dropped the price to $99. I thought it was going to go back up, but we decided to leave it at $99. It's $99 for this workshop. It's probably the best workshop that I've put together so far. You know, by the time you get done, you will know inside and out, delta, vega, and theta. You're going to know exactly how to construct all of these different strategies. Not just what we spoke about today, selling covered calls and buying protective puts, but debit spreads, credit spreads. You ever hear about a condor? You know, I wish I could do a condor. It's not the bird, it's an option strategy, as my teacher used to say. They're supposed to be 1 hour each, but I can almost guarantee it's going to be longer than that. By the way, and it's not on the calendar yet, it will be in the next day or so. We've had a lot of demand for this. We're hosting the big options course. It's going to be the end of the month. We'll have it on the calendar in the next day or so. This is an unbelievable package. It's a 3-week session. It's 18 hours of pre-recorded material. I'll be hosting it live. We're going to go through every single facet of the options market that we talk about here, from the Greeks to the spreads to, you know, the more exotic strategies. But we're also going to have so much time to practice all these strategies on live market conditions. Literally lasts for 3 weeks. And, you know, you also get 2 months of live cyber group trading room in addition to that, where we talk about the option strategies and we talk about, you know, all this other great stuff. Okay? In addition to that, we have so much going on here, by the way. June 4th through 7th, we're hosting an on-site course in our facilities, Syosset, New York. In addition, you'll receive a special VIP ticket to the Street Monster event in New York City. Includes a tour bus. I believe there's free drinks as well. I think, right? And you will meet the option pro John Nigerian, the infamous Jim Cramer, and, of course, the infamous staff at Cyber Trading University, including yours truly. And last but not least, if you have not already, we have just introduced a brand new Cyber Trading University social networking experiment. It's like Facebook, but it's better because it's only trading. Here we talk about Forex, stocks, options, everything under the sun. We've been adding new content on a daily basis. I have a small amount of Cyber Trading University friends so far, so if you do join, please friend me. The more the better. Can never have too many friends, right? And a New York sightseeing tour before the event? I think so. Yeah, that's what I heard. I can't guarantee we're going to go all over Manhattan, but certainly it's comprehensive. At any rate, so we will be here again 8:30 tonight. We're going to go over this material again. The PowerPoints very shortly. We're all going to open up a new forum inside the Cyber Trading University social networking site, which is my.cybertradinguniversity.com. Very shortly, we will post the PowerPoints there. However, in the interim, if you go to our website, cybertradinguniversity.com, click on the course archive button, and they'll provide you with all of our archived sessions along the way, including this one as well, which we are recording. Okay, so the PowerPoints, I promise they will be posted very shortly. The archives, the video already happened. I'll be back tonight 8:30. Remember, tomorrow morning 9:30 when the opening bell rings, day 2 of what we spoke about today, and tomorrow at 12 noon. It's only $99. It's a very comprehensive workshop on all the Greeks and a lot of different option strategies. Spreads is what we're going to be talking about. I thank you all very much for joining us. I wish you a great evening. I look forward to seeing you back soon. It's been a great pleasure. Wow, great group. I hope that you'll join me again tonight 8:30. If not, definitely tomorrow 9:30. Have a great evening, everyone.